Hello, and welcome to the second session of Basics of Partnership Accounting. In our first session, we spoke about what is partnership and what are some of the provisions that needs to be taken into account while doing partnership for accounting. Now, in this second session, we will talk about treatment of capital and treatment of drawings. So let's begin. When we talk about treatment of capital, before that, we should understand a couple of terms. And the terms that we are going to discuss are capital. So capital refers to the amount that owner of business invest in the business. If we talk about interest on capital, the return or the incentive provided to the owners for the amount invested in the business by the owner is termed as interest on capital. The next term is appropriation of profit. The literal meaning of word appropriation is to set money or funds aside for a specific purpose, or it is transferred to a specific account. So in simple terms, we can say appropriation means distribution. Hence, appropriation of profit means distribution of profit among the partners or allocating the share in profit to various partners. Divisible profit, the profit that is available for distribution or appropriation among the partners after making all the adjustments is termed as divisible profit. In the subsequent slides, we will go through a detailed calculation how the divisible profit is calculated. Because in our previous session, we have discussed that the net profit is calculated in profit and loss account, and then the net profit is transferred to profit and loss appropriation account. And in profit and loss appropriation account, we make some adjustments in regard to interest on capital, salary, commission, or the amount that needs to be transferred to general reserve, interest on drawings. So after making all these adjustments, the required amounts are added back to the net profit, and the amount of some amounts are deducted from the net profit. Then the final amount which is available for distribution as share in profit among the partners is termed as divisible profit. Effective employed capital. There may be scenarios where a partner start the business by contributing a certain amount in the business, but at a later stage, depending on the situations, partners may invest in additional amount as capital in the business or may withdraw a part of capital. So the amount that is available for use by the business at a given point in time is termed as effective employed capital. So for example, a partner started a business with 70,000 rupees. And after 5 months in the accounting period, the partner has withdrawn 20,000 rupees from his capital. So for rest of the 7 months, the business will have only 50,000 at its disposal. So if you want to calculate interest on capital for this partner, then you will not calculate interest on capital for 70,000 for 12 months, nor for 50,000 for 12 months. So for first 5 months, we will calculate interest on 70,000, and for rest 7 months, we will calculate interest for rupees 50,000. So for first 5 months, the effective employed capital was rupees 70,000 because that was the amount that was available with the business for usage. And for rest 7 months, we will calculate interest on capital for rupees 50,000 because for the last 7 months of the accounting period, the amount available for business was rupees 50,000. So any amount that is available at a particular time for usage by the business is known as effective employed capital. And interest on capital is always calculated on effective employed capital and not on the opening or closing balance of the capital account. Moving further, what are the methods of maintaining partners' capital account? Basically, there are two methods of maintaining partners' capital account. That is fixed capital account method and fluctuating capital account method. What is the difference? When the partners' capital account are maintained following this method, the balance of capital account will change only when there is change in capital contribution by the partner. The balance of capital account will not change on account of any other transaction other than partner bringing in some additional capital or partner withdrawing some amount of capital from the firm. Whereas in case of fluctuating capital account method, the balance of capital account will keep on changing even when the partner has not brought in any additional capital or has not withdrawn any part of the capital. Let's try and understand this difference in detail. Meaning we have already discussed number of accounts maintained for each partner. When the partner's capital account is maintained using fixed capital method of accounting, then for each partner, two accounts are maintained. That is partner's capital account and partner's current account. Whereas in case of fluctuating capital method, only one account is maintained for each of the partner. That is partner's capital account. Changes in balance of account. The balance of capital account changes only when there is introduction of additional amount of capital or withdrawal of portion of capital. And this withdrawal of portion of capital should be specifically mentioned that partner has withdrawn this much amount from its capital. So remember, withdrawal of portion of capital and drawings are two different things. So don't mix them. If there is no additional amount of capital brought in or there is no portion of capital withdrawn by the partner or by the owner, then the balance of capital account remains fixed. Whereas in case of fluctuating capital method, the balance keeps on changing on account of various other transactions in addition to addition or withdrawal of capital. If we talk about adjustments, no adjustments regarding salary, interest, and commission are made in partner's capital account. Whereas in case of fluctuating capital account method, all the adjustments are made. If we talk about the balance of capital account, the balance of capital account will always remain positive or credit. It will never be negative or debit balance in case of fixed capital method. Whereas in case of fluctuating capital method, the balance of capital account may go negative or the balance of capital account may show a debit balance. Whereas in case of fixed capital method, the balance of capital account will always be positive or the balance of capital account will always be credit. Moving on, presentation in balance sheet. How the balances are shown in the balance sheet. When you are maintaining the partner's capital account using fixed capital method, both the accounts are shown separately in the balance sheet. And as I have told you that balance of capital account will always be credit. So the capital account of partners will always be shown on the liability side of the balance sheet. Whereas the balance sheet of whereas the balance of partners current account, if having credit balance, would be shown on the liability side, and if the balance of partners current account is showing a debit balance, then it will be shown on the asset side of the balance sheet. Whereas in case of fluctuating capital method, we have only one account for each partner, and depending on the balance disclosed by the partner's capital account, it would be shown on the liability side if the balance of partner's capital account is credit balance, and will be shown on the asset side of the balance sheet if the partner's capital account is having a debit balance. Now, if we talk about recording of transactions, then in partner's capital account, we record only two transactions. That is addition of capital or withdrawal of capital. Mind it. Withdrawal of capital other than drawings. And in partner's current account, we record all the transactions related to interest on capital, interest on drawings, commission, salary, share in general reserve, share in goodwill, share in profit, or share in loss. So all the other transactions other than addition or withdrawal of capital are recorded in partner's current account. But in case of fluctuating capital method, all the transactions related to partner are recorded in partner's capital account. At times, for some calculations, it is required that we need to calculate the opening balance of partner's capital account. And the opening balance of partner's capital account can be calculated using the following formula. You may come across such scenarios where the closing balance of partner's capital account is given in the question, and all the other adjustments are also mentioned, that how much capital has been introduced or how much capital has been withdrawn, what amount has been credited to partner's capital account as share in profit or interest on capital or salary or commission, so on and so forth. And taking the closing balance of partner's capital account as base, you need to find out the opening balance of capital account. So in order to do that, all the amounts which has been recorded in partners on the debit side of partners capital or current account will be added. That is drawings, interest on drawings, capital withdrawn during the year, and loss, if any, debited to partners capital account or partners current account. So all these four items will be added back to the closing balance of partners capital account. And we will deduct the profit credited to partners capital or current account, interest on capital, salary, commission, or any additional capital brought in by the partner. Now here, you may see that capital withdrawn during the year or additional capital introduced by the partner during the year are written in different color as compared to rest of the text. The reason is these are the two items you will consider for calculating the opening balance of capital account if you are maintaining the partner's capital account using fixed method of capital. So capital withdrawn during the year would be added, and additional capital introduced by the partner during the year would be deducted from the closing balance of partner's capital account in case of fixed capital method to arrive at the opening balance of partner's capital account. And if you are maintaining partner's capital account using fluctuating capital method, then all these items would be taken into consideration. Let's move on. Appropriation of profit according to capital ratio. In this method, the divisible profit or the profit is appropriated or distributed among the partners in the ratio of the capital employed in the firm during the accounting period. The opening and closing balances of partners' capital account may be different, and partners may have brought in additional capital or may have withdrawn some part of the invested capitals during the accounting period. So when you have to appropriate or distribute the profit according to the capital employed, then considering the above two factors, we use the effective capital employed ratio. so that the profits can be distributed accordingly among all the partners. Now, to calculate the effective or employed capital, the following formula is used. The amount of capital employed or invested multiplied by number of months. So the amount of capital employed means the amount of capital available for usage by the firm, and the number of months. The number of months means months for which the amount of capital will be used by the firm. It is calculated by finding out the difference between the month in which there is a change in capital and the last month of the accounting period. Earlier, I gave you one example that a partner initially invested 70,000 as capital in the firm. But after 5 months, he has taken away 20,000 from the capital employed and leaving 50,000 as capital in the partnership firm. So for the first half of the year, that is first 5 months, the effective capital employed was rupees 70,000. So in order to calculate the number of months for which we have the capital of 70,000, what we will do is we will deduct the number of months in which there was a change in capital. So the change in capital was for 7 months. So in total, we have got 12 months in an accounting period. Out of that, in the last 7 months, there was a change in capital. So we will deduct 7 from 12. The result would be 5. So for first 5 months, the effective capital was 70,000. And for second half of the year, or for the last 7 months of the year, the effective capital employed in the firm was rupees 50,000. If there is no change in capital contributed, then the opening balance of the capital account will be multiplied by 12. So here is an example. A, B, and C started a business in partnership. A contributed 50,000 for the whole year. B introduced rupees 40,000 at first and increased it to 46,000 at the end of 4 months, but withdraws rupees 16,000 at the end of 9 months. C invested 80,000 at first, but withdraws rupees 20,000 at the end of 5 months. The firm earned a profit of rupees 23,750 during the year. Distribute the profit among the partners basis the effective capital employed by each partner during the year. So now, first of all, we need to calculate the effective capital employed. So for A, there was no change in capital. So we have straightway multiplied 50,000 by 12 months. For B, for first 4 months, the effective capital employed was 40,000. So we multiplied it by 4. 46,000 was employed in the business for 5 months, and 30,000 was employed by B in the business for 3 months. So we have separately calculated the product for each of the amount of capital contributed by B. For C, initially or in the first 5 for the first 5 months of the accounting period, the capital employed was 80,000, and for last 7 months, the capital employed by C in the business was 60,000. So we have multiplied 80,000 and 60,000 by 5 and 7 respectively to get the products. Once we get the product, what we will do is we will find the ratio of capital contributed, and the ratio that we have worked out is 30:24:41. Now this 23,750 would be divided between A, B, and C in the ratio of 30:24:41, and we have divided these ratios by 95 because 95 is the total of all the 3 ratios. So this is how the profit can be distributed or the appropriation of profit can be done among the partners on the basis of capital employed ratio. Moving on, the treatment of interest on capital. As we already discussed that what is interest on capital, so the incentive provided to the partners or the owners to invest more and more capital in the business is known as interest on capital. And this interest on capital can be treated as charged against profit or can be treated as appropriation of profit. So there are two basic differences between in these two conditions. When the interest on capital is treated as charged against profit, then the interest on capital would be recorded in profit and loss account and not in profit and loss appropriation account. Because when any expense, because when the firm is paying interest on capital to the partners, that means it is an expense for the firm. And when any expense is treated as a charge, that means it will be considered as any other expense that the business is incurring, and all the expenses are recorded either in trading account or in profit and loss account. And as the interest on capital, if treated as charged, will be an indirect expense, so we will record it on the debit side of the profit and loss account. That is number one. Number two, whether the firm has earned sufficient profits or not, or even the firm has incurred losses, then also interest on capital would be provided if the interest on capital needs to be treated as a charge. Whereas if the interest on capital is to be treated as appropriation of profit, then the interest on capital would be shown in the profit and loss appropriation account, because now we are allocating some part of the profit to the account of interest on capital. So it is not an expense, but it is a kind of distribution of profit in different heads. Secondly, if the firm has not earned sufficient profit, which is equivalent to the total amount of interest on capital that needs to be provided, then the interest on capital would be restricted to the amount of profit earned. For example, the total interest on capital that needs to be paid to the partners, all the partners, amounts to 12,000, but the profit earned by the partnership firm is 10,000 for that particular accounting period. Then the interest on capital would be provided only up to rupees 10,000 and not 12,000. And this will happen only when the interest on capital is treated as an appropriation of profit. So these are the two basic differences when the interest on capital is treated as charge against profit, or the interest on capital is treated as appropriation of profit. On this slide, we have provided you a summary of how the interest on capital is treated. So the first case would be there is no partnership deed, or there is partnership deed, but it is silent about interest on capital. That means it is not talking about whether the interest on capital needs to be provided or not, and if it needs to be provided, then at what rate it needs to be provided. So the partnership deed is absolutely silent, or there is no partnership deed at all. So in this case, no interest on capital would be allowed to the partners. Then there can be a second situation where there is a provision for interest on capital in the partnership deed, but it is silent about the way in which the interest on capital needs to be treated. That means the partnership deed is saying that, yes, we will provide interest on capital to the partners, and we will provide interest on capital to the partners at the rate of, say, 12%. But The partnership deed has not made it explicitly clear that whether the interest on capital would be treated as charge against profit or will be treated as uh, appropriation. Then in that case, the first thing would be, according to section 13C of Indian Partnership Act of 1932, interest on capital would be allowed only if there is profit. So here, yes, we will provide interest on capital, but whether it will be a charge or an appropriation, that is not clear. So the interest would only be provided if there is profit. If there is no profit, no interest on capital. And if there is loss, then also no interest on capital would be provided. If the profit before interest on capital is less than the interest on capital, for example, the firm has earned a profit of rupees 10,000 and the interest on capital needs to be, the total interest on capital that needs to be provided to all the partners amounts to rupees 12,000. Then in this case, the interest on capital would be restricted to the amount of profit. So that means we will just pay interest to the partners on their capital only up to extent of rupees 10,000. The next scenario can be if the profit before interest is equals to or more than the interest on capital, then a full interest on capital would be provided. So for example, the interest on capital needs to be provided to all the partners amounts to rupees 12,000 and the profit earned by the partnership firm is rupees 15,000. So in this case, the entire 12,000, the interest of entire 12,000 on partners' capital would be provided to the partners. Another case, if the partnership deed provides for treating the interest on capital as charged against profit. That means partnership deed is telling that, yes, we will provide interest to the partners. We will provide interest to the partners at the rate of 12% per annum. And this will be considered as a charge against profit. Then in that case, the partnership firm has to provide interest on capital to the partners. And it has to provide full interest on capital to the partners, even if there is no sufficient profit or even there is loss. So, for example, the total amount of interest on capital due to all the partners is 12,000 and the firm has earned a profit of only 6,000. Then also the firm will have to pay interest to the partners on their capital to the extent of rupees 12,000. And how this deficit of 6,000 will be met up, or how this gap of 6,000 between the amount due to partners as interest on capital and the profit earned by the partnership firm, how this gap would be bridged, that is something we will discuss on the subsequent slides. Now, the last point. If the partnership deed provides to treat interest on capital as appropriation, then in this case, interest on capital would be provided to the extent of profit earned. Again, taking the same example, the partnership firm needs to pay 12,000 as interest on capital due to all the partners, but the partnership firm has earned a profit of rupees 6,000 only. Then in case the interest on capital needs to be treated as an appropriation, then interest on capital would be provided up to rupees 6,000 only. Now we have discussed these different scenarios in detail one by one. First scenario, no interest on capital would be provided. So all the profit that has been the entire amount of net profit that has been disclosed by the profit and loss account would be distributed or would be the appropriation would be done in the different heads other than interest on capital. So here in this profit and loss sample profit and loss appropriation account, you would not see any entry related to partner interest on partner's capital. We have net profit, we have interest on drawings, we have partner salary, partner's commission, amount transferred to general reserve, and uh, distribution of profit among the partners. Here, note one thing. The net profit was 10,000. Interest on charged by the firm on partner's drawing was 2,000. So the total of credit side is 12,000. Out of this 12,000, 2,000 we have appropriated to salary account, 2,000 we have appropriated to commission account, and 2,000 we have appropriated to general reserve. So out of this 12,000, we have taken out 6,000 rupees and put it under different accounts. Now, the balance 6,000 that is available with us for distribution as profit among the partners, this 6,000 is your divisible profit. That means the net profit disclosed by the partnership firm was by profit and loss account was 10,000. 2,000 was added on account of interest on drawings, but 6,000 was taken out from this 12,000 for different accounts. And the balance amount, which was to be distributed among the partners as their share in profit, this 6,000 is your divisible profit. Let's move on. Scenario 2 and 3. The scenario 2 and 3, the provision of interest on capital is there in the agreement, but the agreement is silent as to the treatment of interest on capital as a charge or appropriation, and there is no profit or there is loss during the accounting period. Then in that case, no interest on capital would be provided, and the divisible loss, that is net loss after making other adjustments or appropriations, would be distributed among the partners in the profit sharing ratio. So here the net loss has been disclosed by the profit and loss account, and this loss has been distributed among the partners in their profit sharing ratio. Moving to scenario number 4, there is provision for interest on capital in partnership deed, but it is silent about treating the interest on capital as charge against profit or treat as appropriation. And if the profit before interest on capital is less than the interest on capital, then what will happen? Interest on capital would be restricted to the amount of profit, and this will be distributed in the ratio of interest on capital. Let's see the calculation. There are 3 partners, that is A, B, and C. And these are the amounts of capital contributed by the partners. The rate of interest on capital is 12%. The amount of interest on capital is worked out to be 12,000, 18,000, 21,600. So the total of interest on capital due to all the partners amounts to 51,600. Whereas the profit earned by the partnership firm during the accounting period is only 45,000. So now this 45,000 would be distributed among the partners for interest on capital, and this will not be distributed in their profit sharing ratio, but in the ratio of their interest on capital. So when we calculate the interest on capital ratio for these partners, this comes out to 10:15:18. So this 45,000 would be distributed among these partners in the ratio of 10:15:18. When this distribution is done, the profit and loss appropriation account would look like this. By profit and loss account, the net profit transferred from profit and loss account is 45,000, and this 45,000 is distributed among the partners on account of interest on partners capital account, and that this distribution is not, remember, is not in the ratio of their profit sharing, but in the ratio of their interest on capital. Moving on to scenario number 5, there is provision for interest on capital, And the partnership deed is silent whether it needs to be treated as charged against profit or appropriation, but the profit earned by the partnership firm is equals to or more than interest on capital. Then in that case, full interest on capital would be provided to the partners. And here is the calculation. Partners, same ABC, profit sharing ratio 1:2:3. The capital contributed by the partners, rate of interest on capital is 12%. Interest on capital worked out to be 12,000, 18,000, and 21,600. So the total interest on capital due to the partners is 51,600. But the profit earned by the partners or the partnership firm during the accounting period amounts to 55,000. So first of all, out of this 55,000, 51,600 would be distributed among the partners as interest on capital. And then remaining 3,400 would be distributed among partners in their profit sharing ratio. For distributing this 3,400, we would not consider the ratio of interest on capital, but we will consider the profit sharing ratio of the partnership firm. So coming to scenario number 6, the partnership deed provides for interest on capital, and it is mentioned very clearly in the partnership deed that it would be considered as charged against profit. Then what will happen? If the interest on capital is to be treated as charged against profit, the interest on capital will be full interest on capital will be provided whether there is sufficient profit or even losses. So here again, the same scenario. 3 partners, this is their profit sharing ratio, this is their amount of capital invested, this is rate of interest, interest on capital, coming to 51,600. But the profit earned by the partnership firm for the accounting period is only 45,600. So now there is a deficit of rupees 6,000. So how we are going to make up for this deficit of 6,000? So this 6,000 would be charged to partners' capital or current account, as the scenario may be, depending on whether you are maintaining the partner's capital account as fixed using the fixed capital account method or fluctuating capital account method. So we need to provide interest to partners on their capital to the extent of 51,600, but the profit earned by the partnership firm during the year is only 45,600. So in order to bridge the gap of this 6,000, we will take the amount from partners' capital or current account in their profit sharing ratio. Mind it, the amount, the deficit amount that is required to pay the full amount of interest on capital due to the partners would be charged from partners' capital or current account in their profit sharing ratio and not in the ratio of their interest on capital. That's number 1. Number 2, if we look at the accounting treatment, if the partnership deed provides for treating the interest on capital as charged against profit, then this will appear in the profit and loss account and not in here. You see, we have prepared the profit and loss account and not the profit and loss appropriation account. If the partnership deed provides for treating the interest on capital as charged against profit. So if the profit interest on capital needs to be treated as charged against profit, then interest on capital, partners' capital would appear in the profit and loss account and not in profit and loss appropriation account. So here the gross profit transferred from trading account is 45,600, and the total amount of interest on capital due to the partners is 51,600. So we have brought in additional 6,000 from partners capital account, and this amount will be taken from the partners in their profit sharing ratio. So total we have got 51,600, and this entire 51,600 has been distributed among the partners as interest on partners capital account, because we need to consider this interest on capital as charged against profit. Next scenario, scenario number 7, which is the last scenario. If the partnership deed provides to treat interest on capital as appropriation, in that case, what we will do is we will distribute the profit among the partners as interest on capital to the tune or to the amount of profit earned by the partnership firm. So here the capital invested by the partners are 1 lakh, 1,50,000, 1,80,000. Rate of interest on capital is 12%. So 12,000, 18,000, 21,600. Total comes out to 51,600. But the profit earned is only 45,000. So this 45,000 would be distributed among the partners in the ratio of interest on capital, which is this 10:15:18. Here, as this is appropriation, so even if there is any deficit, we would not bring in amount from other accounts to meet that deficit. Whatever profit we have earned, we will pay interest up to that amount only. And here again, we will prepare the profit and loss appropriation account. 45,000 has been provided to the partners as interest on partners capital account, and this is distributed in their ratio of interest on capital. So that's pretty much in regard to partners capital account, or in how the partners capital accounts are treated. Now, as we have come to end of treating the partners capital accounts and how the partners interest on partners capital is treated, let's move back and look at how the drawings are treated for partners in a partnership firm. So first thing first, let's understand what are drawings. Drawings refer to the act of withdrawal of cash or assets from the company by the owners for personal use. Drawings can occur by withholding cash from a business account, but can also include anything that is considered as business asset, such as products or equivalent that is removed from the business for personal use by owner. So remember, it is not necessary that each and every time the drawings would be in form of cash. Even if the assets of partnership firm or the business entity is used for personal use, it is considered as drawings. The second term that we need to understand is interest on drawings. The amount charged by the firm or business from the owners to discourage the drawings, or the compensation that firm gets for allowing the owners to use its money or value of money, is known as interest on drawings. Because if the partners will keep on drawing the money from the business, then obviously the business will run in a cash crunch. So if the interest is charged on the amount that the partners are taking from the business for their personal use, then partners would not be very keen to withdraw the amount from the money or using the assets of business for their personal use. So that is what is interest on drawings. You can say interest on drawings is just opposite of interest on capital. Any type of drawing reduce the capital or owner's equity of a business. So it is important to keep a track of these drawings and manage them within your accounts. However, drawings are not considered as business expenses. What are the types of drawings? There are basically two types of drawings, that is drawings against capital and drawings against profit. Drawings against capital is when the drawing is made in excess of profit generated by the firm from its operations. Whereas drawings against profit refers to a situation when the owner withdraw funds from the company. The funds withdrawn is taken out of profit generated from the operations, that is sales, etc. Drawings against capital is drawings against capital is part of capital, where drawings against profit is part of expected profit or the anticipated profit. Drawings against capital is debited to capital account, whereas drawings against profit is debited to drawings account. On this slide, we have presented a summary of difference between drawings against capital and drawings against profit. So that what we have already discussed. The only thing, additional thing on this slide is effect on capital. The drawings against capital reduces the capital, but drawings against profit does not reduce the capital. Moving further, there are a couple of points that you must keep in mind in regard to drawings. That is, interest on drawing is not charged unless the partnership deed specifically mentions that interest on amount drawn by the partner is to be charged. The partnership deed also specify the rate at which the interest needs to be charged. Then interest on drawings is a gain for firm, because whenever the interest on drawings is charged, then firm will have some earnings. Interest on drawing is loss for the partners because partner will pay this amount to the firm. So it is a loss for the partners at individual level. Interest on drawings should be shown on the credit side of profit and loss account. Profit and loss appropriation account, just what we have seen in our previous slides. Then interest on drawings is recorded on the debit side of partner's capital or current account, because interest on drawings will always decrease the claim of partner on the assets of the partnership firm. So there, the liability of the partnership firm will reduce whenever interest on partner's drawing is charged. That's the reason the partner's capital or current account is debited. There are a couple of other things that you must remember in regard to interest on drawings. First, interest on drawings is charged only on the amount of drawings which is earned from the partnership firm. It is not charged on the amount invested in the partnership firm by the partner. One should see in question that whether a specific mention is there that interest on drawing is out of amount invested in partnership firm. In such a case, no interest on drawing is charged. However, in most of the questions, this is not mentioned. Hence, interest on drawing should be charged in those cases. So if the partner is withdrawing the amount from the capital invested, that means he is withdrawing part of his capital. And when we would calculate the interest on capital, we will take away that amount. So the interest on capital would compensate for interest on drawings. But in most of the cases in questions, there is no mention there that whether the amount is withdrawn against the amount invested by the partner in the partnership firm or not. So in most of the cases, we would charge interest on drawings. Interest on drawing should be calculated from the date of withdrawal of the amount. In absence of date of withdrawal, interest should be charged for 6 months on the whole amount, because it would be assumed that drawings were made evenly throughout the year. So if in question, it is mentioned that the partners has withdrawn 20,000 during the year, and There is no mention that on which date that 20,000 was withdrawn from the partnership firm. Then we will charge interest on that 20,000 for 6 months, considering that the amount was withdrawn by the partners in equal installments throughout the year. And 6 months is the average that we take into consideration. Last but not the least, when the rate of interest is given without the word per annum, interest would be charged without considering the time or date of drawings. In other words, interest would be charged for 12 months. So these are the 3 points that you must consider before working out the interest on drawings. Now let's look at the methods of calculating interest on drawings. So there are 3 commonly used methods for calculating interest on drawings. That is simple method, product method, and average period method. We will go through all these methods in detail one by one. In the simple method, the interest on drawings is calculated separately on each amount of drawings from the date of drawings till the close of accounting period. And the formula used for calculating interest on drawings using simple method is amount of drawings multiplied by rate of interest divided by 100 multiplied by number of months divided by 12. Amount of drawings. This is the amount that has been withdrawn by the partners from the partnership firm for their personal use. Rate of interest means the rate at which the interest needs to be charged on drawings. Number of months. Number of months means the months for which the amount of drawings will be used by the partner. It is calculated by finding the difference between the month in which the drawings are made and the last month of the accounting period. On the following slide, we will discuss one example to make it more clear. Charu is a partner in a firm. She withdrew the following amounts during the year ended on 31st of March 2018. And the interest on drawings needs to be charged at the rate of 9% per annum. And you are supposed to calculate the interest on drawings. So for calculation, we will use the simple method. And these are the amounts of drawings along with the dates on which the drawings were made. So how we are going to solve this? We will use this table. So the first amount of 20,000 was withdrawn on 1st of May. And as you know, the accounting period starts on 1st of April and ends on 31st of March of the following year. So if the amount was withdrawn on 1st of May, then this amount of 20,000 would be used by Charu for 11 months. So we have calculated interest on 20,000 for 11 months at the rate of 9% per annum. Similarly, the second amount was withdrawn on 31st of July, which means on the 1st of August. So from August till 31st of March, the time period is of 8 months. So we have calculated interest on 10,000 for 8 months at the rate of 9% per annum. That's how we have done the calculation. So here in the simple method, as shared earlier, the interest on each amount of withdrawal is calculated separately. And the total comes to 5,250. No interest is charged on the amount withdrawn on 31st of March because that is the last day of our accounting period. So in that particular accounting period, this amount is not even used by the partner at all. That's the reason we have not calculated any interest on this 25,000. Moving further, the second method of calculating interest on drawing is product method. In product method, first of all the products are computed by multiplying each set of drawings from its duration. Thereafter, the different products are added and the interest is calculated on the total of products so arrived at for 1 month only. The advantage of this system is the separate calculations are not required each time. Formula used for this method of calculating interest on drawing is total of products multiplied by rate of interest divided by 100 multiplied by 1 upon 12, because we are calculating interest only for 1 month. So the products is the only new term that we are using here in this method. And the product is amount of drawings multiplied by the number of months for which the amount has been used. Let's look at the example. The same question, same amounts, same dates, everything is same. Only changes here, instead of using the simple method, we will use the product method. And this is how we are going to solve this. So what we are going to do is, instead of calculating the interest for each amount of drawing, we will calculate the product. And to calculate the product, what we have done is we have multiplied the amount of drawings by the number of months it would be used by the partner. So 20,000 multiplied by 11, the product is 2,20,000. 10,000 multiplied by 8 comes to 80,000. 30,000 multiplied by 6 comes to 1,80,000. Then again, similarly, 31st of March is the is the last date of the accounting period. So again, it is not used for any amount of time. So the period for which the this amount of 25,000 is used is 0. So 25,000 multiplied by 0 comes out to be 0. Then in the next step, what we will do is we will do a sum of all the products, which comes out to 7 lakhs. Now on this 7 lakhs, we will calculate the interest at a rate of 9% per annum. But remember, we will calculate this interest only for 1 month, which comes out to 5,250. So you can see that in both the cases, whether you are using the product method or you are using the simple method of calculating interest on drawings, in both the cases, the amount of interest on drawings is same, that is 5,250. Then comes the average method. Average method of calculating interest on drawings. This method of calculating interest on drawings can be used only when two conditions are satisfied. And those two conditions are, first, the amount of drawing should be equal. In the previous example, we have seen that the drawings were not of uniform amount. Sometimes it is withdrawn 20,000, 10,000, 30,000, 25,000, so on and so forth. So if you had to use average method of calculating interest on drawings, the first and foremost condition is the amount of drawing should be equal. That's number one. Number two, the time gap between the drawings should be equal. In the previous example, we have seen sometimes it was withdrawn at the beginning of the month. Sometimes it was withdrawn at the end of the month. Sometimes the time difference between two drawings was 1 month. Sometimes it was 3 months, so on and so forth. So if the two conditions, that is the amount of drawings are equal and the time gap between the drawings is equal, then only we can use the average method. And the formula for calculating the interest on drawings as per average method is amount of drawings multiplied by rate of interest divided by 100 multiplied by average number of months divided by 12. So here, the amount of drawings means, here remember, even the amount of drawings is equal. Say for example, the partner is withdrawing 2,000 rupees every month. Then we will not multiply, we will not consider 2,000 as amount of drawings. We will consider 24,000. That is 2,000 withdrawn every month. So 2,000 multiplied by 12. So amount of drawings would be 24,000. That's number one. Number two, the average number of months. the average number of months for which interest needs to be calculated. So on the subsequent slide, we have discussed the different scenarios, that what would be the average number of months if the drawings are made on 1st of every month, what would be the average number of months if the drawings are made on the first day of every quarter, or what would be the number of average months if the drawings are made on the last day of every quarter. So these are there are in total 12 scenarios which are being explained on the subsequent slides. And we have also presented you with a table showing the average number of months that you need to take into consideration while calculating interest on drawings using average method in all the 12 scenarios. So if we talk about scenarios, the first scenario is when the drawing is made on the first day or beginning of every month. Second scenario, when the drawings are made at the end of every month. Third scenario, when the drawings are made at the middle of every month or at any time during the month. Similarly, if we talk about quarterly basis, beginning of the quarter, end of the quarter, or during middle of the quarter of middle of the each quarter. Then if the drawings are made on 6 monthly basis or half yearly basis, then when the drawings are made only once in every 6 months at the beginning of the period, end of the 6-month period, or any time during the period of 6 months. And the last and very rare scenario, when the drawings are made for the period of 9 months. So the partners are making a drawings once in every 9 months. Then also at the beginning of the this period of 9 months, or at the end of this period of 9 months, or anytime during this period of 9 months. So these are the 12 different scenarios where you can use the average method of calculating the interest on drawings. But as mentioned earlier, the average method can only be used if the amount of drawings are uniform or equal and the time gap between the drawings is equal. As I said earlier, we have presented this table where in each scenario, what is the average number of months that you need to take into consideration. If the drawings are made on the first day or beginning of every month, the average number of months that you would use in formula is 6.5. So the formula will become amount of drawings multiplied by rate of interest divided by 100 multiplied by 6.5 divided by 12. In case of end of every month, the 6.5 will get replaced by 5.5. In case of the drawings made during the middle of every month, in the formula, we will use 6 months as the average number of months. So these are the 12 scenarios. And in the last column, we have provided you with the average number of months that you should be considering while calculating the interest on drawings using the average method. When the total amount withdrawn is given, but the dates of withdrawals are not specified, it is assumed that the amount of withdrawn was even throughout the year. And for calculating interest, the period would be taken as 6 months, assuming it's the average period, and the amount withdrawn evenly in the middle of the month throughout the year. So if it is not clearly mentioned that when the amount was withdrawn, or how was the drawings, whether the amount has been withdrawn in one go or it was withdrawn in parts, and even if it was withdrawn in parts, then at what point of time the drawings were made, then we will assume that the drawings were made evenly done throughout the year, and we will take 6 months as average to calculate the interest on drawings. And here amount of drawings, because here remember, the split is not given that when the amount was withdrawn or how the amount was withdrawn. So the total amount of drawings would be considered as amount of drawings. Then rate of interest on drawings, the rate at which we need to charge interest on drawings divided by 100 multiplied by average period, and average period is 6 months divided by 12. So with this, we come to an end of our this session in which we have discussed about treatment of capital and in how the interest on capital is treated and how the drawings are treated and how the interest on drawings has been calculated. So if you have any questions, feel free to leave your comment and we would be more than happy to respond back to your queries. Thank you very much.